Hello, class, and welcome to our third lecture series on financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. So to begin with, we had our assignment in our last class. So I told you to submit before the class. So all those who already sent me, so I have received it. Some send me through email and some send me on my WeChat ID. So please remember that one. I asked you to send me on Word file, not PDF. And I told you why, because I'm using Microsoft Surface and this pen works very fine and very smooth on Microsoft products, and it's easy for me and quick for me to give you response on your assignments. And the PDF, Acrobat readers and all the stuff, very slow, and it takes more time for me to give you response. So it's better for me and you if you send me the assignment in Word file. All you need to do, just take the pictures and paste it on the Word file, or if you have ePen, just solve it on the Word file, save it and send it to me. Okay, so before going to the chapter here, let's discuss your queries regarding the assignment. So I'm going to pause the video here. So those who are watching online, so I'm just pausing the video here, recording here, and we are going to record once we start our, the chapter 2 here. Okay, class. So we're just free from discussing the solution of our assignment. So I have uploaded the solution. So for those who couldn't submit the assignment, for them, time's up. Okay, I will not accept the submission of the assignment from now on because I already uploaded the solution. Okay, here we go. So today we are starting a new chapter named transaction analysis. So we will, going a step further from analysis of accounting equation, right? We just finished the accounting equation, and which is assets is equal to liabilities plus owner's equity. So let's talk about what we meant by the transaction. So transaction in accounting means any event that has financial impact on the business, right? Financial impact. If something is coming in the business and it has no financial impact, which means that is not a business transaction. For example, cool air is coming to your house or to your office without any air conditioner or without any electricity and all the stuff, because the weather is fine, so you open the windows. So that is not financial transaction unless you install the AC and that cool breeze is cool air is coming inside the office because you are paying for the electricity bill and all the stuff. So that does have financial impact on the business. We call this transaction. Similarly, the barter transactions, if they have no financial impact, we ignore them. Plus, honors. If honor went for holidays from his own pocket, does it has to do with the company? No. If I'm the boss, I just took my kids to the to foreign tour or something with my own money, with not the company money, with my own money, then it doesn't have impact on business, so it is not business transaction. It is my personal transaction, but it is not business transaction. Second attribute or characteristics of transaction is that it can be measured reliably. It's not like that you have a judgment in the, for me, this pen is, in the market, this pen is for 600 because this pen is used by my father. So I just say that, okay, this pen value is 60,000. Emotions are not attached here in business transactions. If the market value is 600, you have to put this pen is 600, not the 60,000, right? Plus, a transaction must have at least two sides. One is something is given and something is received. So there is a receive side and there is a given side. It's not like that all the both sides are, or all the sides are just given side, or all the sides are received side. So that is the beauty of our transaction. If business invested money, if owners invested money into the business, and business receive cash, and owner receive shares in the business or capital in the business. So what is the give side? Owner receive the capital and business receive the cash. So for the business, it's the insider claim, a liability that he needs to pay back to its owners, right? Similarly, if you purchase goods on cash, business purchase goods on cash, so goods are coming in, cash is going out. There is a receive side, there is a given side. So this is called transaction. So what is the beauty of this transaction? That accounting records both sides of transaction, so that there is no fraud, there is no judgment involved, because we measure it reliably, plus we are measuring both and we are recording both given side and the reception side. How? Let's talk about further. But first we have some practical examples here for transactions. So here, so the company name is Whole Food Market Incorporation. So purchase fresh produce and sell product. So in that case, okay, borrow money and repay loans. We have here. So when they purchase products, what do we mean by the transaction? That does it have a financial impact? Yes, we purchase it. We purchase products, fresh foods, and sell it to the market to earn money. It does have financial impact. So can we measure reliably? Yes, it must be in given currency. Say if we are in US, it's dollar. If we are in China, it's yuan, right? So when we purchase product, what are the two sides? We receive the product, as a business, we give the cash. When we sell product, we give the product, we receive the cash. Right? So when we borrow money, what will happen? When we borrow money, we receive the cash. As a business, we receive the cash, and we increase the outsider claim or liability. So liability is other side of the equation. So you can say that it's a claim, outsider claim. Repaying loan, it means outsider claim is decreased and our cash is decreased. So there is both given and receipt sign. So we pay back the loans and we receive what? We receive less claim from the outsider. Right? So that has a financial impact, yes, because money is involved. And now our second objective is define, account, and list and differentiate between different types of accounts. Here we go. So we talk about the assets is equal to liabilities plus owner's equity. So what are the accounts? Accounts means what are the heads or titles that we allocate to our assets, to our liabilities, to our stockholder equity. For example, assets, cash is an account. So all the cash transaction must go to the, or cash equivalents transaction must go to the cash account, whether this is banking, checks, receive currencies, all the things will be recorded in cash account. So the account records all the changes in particular assets. If this is asset account, then all the transactions related to asset must be recorded in asset account. If that transaction related to liabilities, it will be recorded in liability accounts. If that transaction is recorded in stockholder equity, it must be recorded in stockholder equity account. So we have accounts here. Number one, asset accounts are number one, cash. So asset, we already talked about that. It has all, all those things which a business have under its possession, and it must have some economic value, right? We talked about that the free air is not a resource, right? Like sunshine is not the resource, but the electricity, light is the resource because you are paying bills. So first asset account is cash. So all the money related issues will be related to here. So we saw in our previous assignment solution, all the cash transactions are written under cash, not any other, not even in banks. Even the bank itself is recorded here in cash. So money including bank account balances, paper currency, coins, certificates of deposits, all the checks are treated as cash to record an asset, because cash is our asset under the possession of business. Account receivable. So it is the promise for future collection of cash from the sale of goods or services. So these are our customers. So if customer have a cash sales, then they are not our account receivable because they fulfill their claim. They paid all their transaction. If I purchase this pen at 600 yuan through cash, then I have nothing to do with the